In just over 24 hours, homeowners are facing another potential mortgage rate shock as interest rates are set to rise again. Many economists predicting that they will hit 3.75% by the end of the year, which could mean an extra £200 a month for repayments on an average tracker mortgage.
Yeah, I might just break that down, if you forgive me. What we're expecting to hear...
That's why you're here, Martin.
What we're expecting to hear tomorrow is an interest rate rise of probably a half a percentage point or 0.75 percentage points, taking current base rates from 1.75% to 2.25 or 2.5%. What that would mean for someone on a variable rate mortgage, if you're on a fixed mortgage, nothing changes until your fixed ends, is very roughly a 0.75% rise would be £40 per month more per £100,000 of mortgage. £40 per month more per £100,000 of mortgage. £200,000 mortgage, it's 80 quid, and then times that price, it's about a grand a year. So that's the scale we're seeing just in the rise expected tomorrow.
Sheldon Mills is here from the Financial Conduct Authority, the man tasked with thinking and worrying about what happens to consumers and how to protect them at the independent, hugely influential financial regulator. Very good morning to you. As Martin said, you've already had plenty of conversations. This is your chance to address the viewers, really, who are extremely worried at the moment. What is your responsibility? What power have you got at the moment to look after people who are watching?
Well, it's really important, and we recognise that many people will be worried about their finances as we go through this cost of living crisis, and we do see the rises in interest rates. In mortgage specifically, many people are actually on fixed-rate mortgages, and that's really helpful for them. But we know that there are at least 2 million people who will be coming up to the end of their fixed rate, and it's really important for those to shop around, contact their lenders in order to see what offers are available as they move forward at the end of that fixed rate.
OK. That's your message to viewers, and now we can engage in a conversation here at the desk. Yeah, Martin.
Look, let us be straight about mortgages. Interest rates are far higher than they were a year ago. When they were at historic lows. And people, when they come to the end of their fix, even if everything is working well, are going to see a much higher fixed rate than they were used to. You know, we were below 1% at one point. Now we're talking 3 or 4% on interest rates. But not only that, and you're in charge of the rules on this, affordability criteria for mortgages are key. To get a new mortgage deal, you need to be able to afford it. And clearly, with the cost of living going up, fewer people will be able to afford new mortgage deals. Are you worried that we're going to hit a critical mass problem here, where people's mortgages just become completely unaffordable? How bad is it looking? You have the data. This is what you do. How bad is it looking as a big picture?
So I'm encouraged by some of the data. We've seen the number of people... We've looked at how many people can benefit from switching their mortgage, and that's come down because a lot of people have moved already onto fixed rates. We are concerned, obviously, for those people whose financial circumstances mean that they may not meet certain affordability checks, and we are encouraging lenders to reach out to as many people as possible who are coming up to the end of the fixed rate and work out how they can best support people in those circumstances.
But we have this weird problem, don't we? You're on a mortgage, you're struggling, you're applying for a cheaper mortgage and you are told you can't afford it, so your mortgage will have to be more expensive than it would be if you got a cheaper mortgage. And clearly that is counter-logical. People are more able to afford mortgages at 3% than they are at 5 or 6%. Are you going to look at changing the affordability criteria to meet the cost of living challenges that are coming?
At present, we don't have any plans to change the affordability criteria, but we are monitoring the impact of what will happen as people come off those fixed rates. And I think if we see significant numbers of people who are struggling in those circumstances, we will have to think about what we can do in response to that.
Because the subprime mortgage crisis, of course, led to the banking crisis. I mean, you know, people not being able to afford mortgages and people will remember, it's a kind of visceral issue, isn't it? Not just for individuals who can't afford to repay their mortgage, but for the wider economy.
We've done a lot of work since the financial crisis and the subprime mortgage impacting that to ensure, and this goes to the affordability question, that mortgages are affordable so that we don't end up in those circumstances again. So we're reasonably confident that any crisis in the economy which is driven will unlikely be driven through subprime-type mortgages.
OK.
Sorry.
Sorry. Martin.
I'm interested to know, I spoke to many in financial services and I'll say many at the regulator when energy prices were looking to go up 80% in October and then another 50% in January. I mean, there was real fear about the catastrophic situation that we could be in. From the data that you have, the new price guarantee, and I know you don't regulate energy, but the new price guarantee, is that enough to mitigate severe financial shock to millions of homes? Is it enough on the data that you have?
So it will help. So it'll bring down, I think the Resolution Foundation and others have looked at the inflation rate for types of individual groups. And for some of the poorest, it will bring down the personal inflation rate. I've seen figures of around 6% it coming down. However, our data shows that there are still millions of people who will struggle even after that helpful support, and will struggle with debt and will struggle with repayments on certain of their priority bills. So it's really important, and if I say one message from the financial regulator to the people out there, it's really important if you are struggling with debt that you open up to someone, you reach out to your lender, or you go to the moneyhelper.co.uk website where there's advice, support and impartial free guidance, and you get support and help in managing your debts and prioritising those.
I've never seen a situation, I need to be straight, that we have been in recently where, and many of the debt counselling agencies, you know, you're talking Money Helper who will direct people to debt counsellors, are saying for the first time that we have people with negative budgets. Even when they reduce everything that they are spending their money on, they have less income than minimum expenditure. That is likely to be in the millions of people. Should more be being done? What more could the regulator do? Or should you be pushing government for more action? Because I know you'll have data on that. You have to be political, you know, you've worked for a regulator, but I know you'll have data on that. How serious is that problem?
Well, I'm always straight talking, Martin, which is probably why you invited me on the show. So, I mean, it is a clear problem. I've spoken to many debt advice charities and debt advice providers up and down the country, and they all report that people are not necessarily coming in for debt advice, but they are coming in with issues and concerns about how they're going to meet their bills. So there are issues there. I'm pleased to say the Money Advice and Pension Service is working with the government to get more funding, to bring in more debt advice, so that will be there to support people as they move through their journey into difficulty and challenge. And we've written, you know, our responsibility is supervising the big lenders in the country and all financial services. And we've written to them to ask them to make sure that they are supporting...
Because they're making a lot of money out of interest rate rises, aren't they? Let's be honest. Savings rates aren't going... Mortgage rates are going up, credit cards and loan rates are going up, and saving rates aren't going up. The gap is the profit. Are they taking too much?
So, I mean, I think I've been public in stating that lenders really need to look very carefully at the value that they're providing to consumers and think about how they're supporting mortgage borrowers, but also how they're thinking about supporting savers. We do see some rates through the competition that is in the saving markets, and we do see mortgage competition on rates still occurring. But I do think lenders do need to now think about, you know, they've had a period of very low base rates. They've gone up. There is some benefit for them in that, and they need to think about how that is reflected in the prices for the products.
That's regulator talk, but get your blooming acts together, isn't it?
I mean, at the end of the day, it's a commercial decision how they price, but we would expect them to be thinking about how they're providing some of that value and benefit to their customers.
In all this talk of interest rates and people facing rising bills, I wonder if there is a concern about the 0% interest credit that's offered through the buy now, pay later options. For instance, when you get to the end of an online shopping order, you're quite often given as a first option, would you like this for free for now? And I imagine that that's fine as long as people understand all the rules around it. Do they? Do we all? And are you concerned about those offers?
So we did a report over a year ago where we expressed that as a regulator we would like to see buy now, pay later come within our regulatory perimeter so that we can regulate it. It's not regulated by us currently, it sits outside. That said, I met with many of the senior people at the buy now, pay later firms just a few weeks ago before the summer to tell them that I expect them to support their borrowers who might be getting into difficulty, and they really need to think about how they're thinking about whether or not people can afford the buy now, pay later that they're taking. That said, people are struggling and they will look for options in order to support and smooth their finances through this period, and buy now, pay later is playing a role there. So we need to have a balance. There needs to be some provision of credit to people as we go through this crisis.
We are waiting for that to be regulated. We're waiting for the law to change. A member of my team sat on that on your panel to do that. And unfortunately, while some of us have been campaigning for buy now, pay later regulation for a number of years, it's not looking like it's going to happen this year. It's looking like it's going to come to your regulation from next year.
Yeah. What happens if you don't pay later, by the way?
So what's interesting with buy now, pay later is some of the consequences of not paying later are not necessarily as great as some of the credit cards that we have, but there can be additional fees. And of course, people can chase you for the money and ultimately take the same sort of approaches that if you got into trouble with your credit card.
Court action.
Sheldon Mills, thank you very much
Thank you very much for having me.
For your company this morning. Really appreciate that.